Many investors are still learning about the various metrics that can be useful when analyzing a stock. This article is for those who would like to learn about return on equity, ROE. By way of learning by doing, we'll look at ROE to gain a better understanding of Suncorp Group Limited, ASXSUN. Return on equity or ROE is a key measure used to assess how efficiently a company's management is utilizing the company's capital. Put another way, it reveals the company's success at turning shareholder investments into profits. Return on equity equals net profit from continuing operations divided by shareholders' equity. So, based on the above formula, the ROE for Suncorp Group is 8.7% equals 1.2 billion Australian dollars divided by 13 billion Australian dollars, based on the trailing 12 months to June 2023. The return is the yearly profit. Another way to think of that is that for every 1 Australian dollar worth of equity, the company was able to earn 9 Australian cents in profit. Arguably the easiest way to assess companies' ROE is to compare it with the average in its industry. Importantly, this is far from a perfect measure, because companies differ significantly within the same industry classification. The image below shows that Suncorp Group has an ROE that is roughly in line with the insurance industry average, 9.4%. That's neither particularly good, nor bad. While at least the ROE is not lower than the industry, it's still worth checking what role the company's debt plays, as high debt levels relative to equity may also make the ROE appear high. If a company takes on too much debt, it is at higher risk of defaulting on interest payments. To know the 2 risks we have identified for Suncorp Group, visit our risks dashboard for free. Virtually all companies need money to invest in the business to grow profits. That cash can come from issuing shares, retained earnings, or debt. In the first and second cases, the ROE will reflect this use of cash for investment in the business. In the latter case, the use of debt will improve the returns but will not change the equity. Thus the use of debt can improve ROE, albeit along with extra risk in the case of stormy weather, metaphorically speaking. Suncorp Group does use a high amount of debt to increase returns. It has a debt-to-equity ratio of 2.05. The combination of a rather low ROE and significant use of debt is not particularly appealing. Debt does bring extra risk, so it's only really worthwhile when a company generates some decent returns from it. Return on equity is one way we can compare its business quality of different companies. A company that can achieve a high return on equity without debt could be considered a high-quality business. If 2 companies have around the same level of debt to equity, and one has a higher ROE, I generally prefer the one with higher ROE. But when a business is high quality, the market often bids it up to a price that reflects this. It is important to consider other factors, such as future profit growth, and how much investment is required going forward. So you might want to take a peek at this data-rich interactive graph of forecasts for the company. But note, Suncorp Group may not be the best stock to buy. So take a peek at this free list of interesting companies with high ROE and low debt.